This is the Money Seed Podcast, where we discuss all things investing, plain and simple, the way it should be. Please remember, this show is for educational and entertainment purposes only and is not intended to be investment advice. Welcome back to the Money Seed Podcast. He's Chris Fergus and I'm Gabriel Svore. Welcome back to the show. We have an exciting show for you today about options. So what are options? When should you use them? When should you perhaps not use them? Let's get right into it. But first things first, we usually profile a famous investor or investment firm. Today, we are talking about Nancy Pelosi. Most of you don't know her as an investment genius. Most of you know her as a politician, as the Speaker of Congress, Speaker of the House. But interestingly enough, she has a net worth of over $100 million together with her husband. And in 2020, her returns on her investments were above $16 million. So her returns, I think, beat most Wall Street titans and Wall Street veterans during that year, which is why she started getting a lot of questions about insider trading. So that's highly controversial. As a politician, you would hope that she's out there working hard for you and me, but she's also at the same time working hard to fatten her wallet. Even at the tender age of 82, she is a very successful investor, buying and selling all kinds of options. We are going to profile one of her options trades that was made public in December of 2021, and we'll look into why she would buy options instead of stocks and what that means in terms of profits and losses in case certain outcomes happen with that stock. All right, let's get right into it. So what are options? So basically, options started out as an insurance policy. The idea was that, let's say you have a lot of money tied up in a certain stock. As an example, let's say it's tied up in General Motors and something weird is happening in the auto industry, or you think there's a slowdown coming in the auto industry, or you think there's a market crash coming or something, or maybe some Japanese cars are being imported that are better quality and you think you're going to lose market share. If you think your stock is going to start dropping, then you would go to your insurance company and say, can I take out an insurance against my shares dropping? And insurance companies will say, sure, you know what, just pay me a few $100. I'll give you an insurance policy. And if the stock crashes below a certain amount, then I will compensate you for your losses below that certain amount. And so let's say you can see this blue line here, but let's say your stock right now is around $110 a share. And you go to your insurance company and you say, look, if the stock goes below $100 a share, then I want to be protected from losses. And so the insurance company says, okay, how long do you want this insurance policy for, right? Just like your car insurance. Let's say it's for 1 year or it's for 1 month. You can buy these kind of insurance policies for any period of time. And so let's say you want to protect yourself for the next 3 months. So you tell the insurance company, for the next 3 months, if the stock goes below $100, I want to be basically protected from any losses below 100. And your insurance company will run their fancy math formulas and they'll say, okay, pay me like $200 or $300 or whatever. And you pay that, and then you have an insurance policy. And then you don't have to worry. If the stock crashes to 70, 80, whatever number the stock crashes to, you are going to be able to sell your stock back to the insurance company for $100 a share so that you don't lose any money below $100 a share. So that's how they got started. And the name of that kind of an insurance policy is a put option, right? And it got started there. But the interesting thing about the stock market, so there's two things that are different from, say, this type of insurance from the insurance on your car. And that is, you can buy this insurance policy even if you don't own your car. So imagine, Chris, that your neighbor, for example, is a really dangerous driver, right? Like the other day, you saw your neighbor like speeding down the street or like burning rubber as he's doing donuts or whatever. And you think to yourself, oh my goodness, my neighbor's going to crash his car any day now. You can take out an insurance policy against your neighbor's car. So you just get a piece of paper that says, if my neighbor crashes his car, I'm going to get all kinds of money, right? Not crashes into you or your house or your car. No, nothing. That has nothing to do with you. But you can take out an insurance policy against your neighbor, right? Your neighbor's car accident. So that's one big difference, is that you can buy insurance policies and things you own or don't own. And the other thing is the stock market is a two-way market, which means you can buy stocks if you think they're going up, or you can short stocks if you think they're going down, which means you can bet on the stock market in both directions, and you can buy insurance policies against the stocks moving in both directions. So you can speculate on stocks moving in both directions. So you can, for example, take out an insurance against someone crashing their car, or you can take out an insurance against somebody not crashing their car. So you can speculate on it both ways, and you don't even need to own a car. It can be somebody else's car. And that's what makes the options market really dynamic, and really, it's all about speculation, right? It started out as an insurance against something bad happening, and it has really turned into speculation. And amongst the younger crowds, ever since the pandemic started, it has become very popular because it's speculative. You can make a lot of money very quickly, and that's why a lot of people like to essentially gamble on stocks by speculating in options.
So how do you make money and how do you lose money?
Yeah, so with an insurance company, right? Like, let's say to use the car analogy again, if you own a car, you have to have car insurance on it. And let's say every single year, let's say the average American, I don't know, pays, let's say $500, so that if they get in a car accident, the insurance company pays them back. In that case, you don't really make money on that. You just stop losing money, right? Now, the way you make money is you sell it to someone else. So if you're the insurance company, you can sell one of these contracts to someone else. You can sell insurance to another person, and then essentially you become the insurance company. You start selling insurance to a lot of people. And if there is no market crash, you can keep all that money. You can essentially become the insurance company if you want to. Now, the other way you can make a lot of money is you can bet on a stock crashing even if you don't have the stock. So let's say you don't own this stock, and the stock right now is trading at $115 a share, to keep using this example. You don't own the stock. You're just looking at it. You're saying, okay, well, you know what? GM stock, it's at $115 a share. They got all kinds of headwinds and difficult market conditions. You can go and you can just buy this insurance policy and say, you know what? If GM crashes, I still want to get paid out to 100. So let's say GM crashes to $50, $60, $70 a share. You can still sell it to somebody at $100 a share, right? It's like you have the insurance policy even though you don't own the stock, which is very profitable because people are out there buying and selling the stock for $50 a share after it has crashed. You can still sell it to somebody for $100 a share. So that insurance policy you have is very valuable.
I think it'll take a little bit to get my head around this as to like the theory kind of makes sense, but the practicality of who's actually buying these stocks, who's selling these stocks, because there has to be a real person at the end of it buying it.
That's correct. And you're right. I remember when I first started looking at this stuff a couple of years back, at first it's definitely confusing, right? Because I understand, it's very easy for me to understand the idea of car insurance, right? My insurance, I crash the car, the insurance company pays me out. But really, this is 4 times more complicated because there's 4 different scenarios, right? I can buy and sell an insurance policy against a car crashing, and I can buy and sell an insurance policy against a car not crashing. So there's 4 different scenarios.
But then how do you lose money?
So basically, you lose money if the stock doesn't crash, right? Okay. It's just like me buying car insurance against my car, and my car never crashes. It's like, oh my God, I pay $500 a year to my insurance company for my car, and I haven't gotten a speeding ticket or a claim on my insurance in the last 10 years, right? So I feel like I'm losing money every year because I'm just paying out and no money's coming back from the insurance company, right?
So if you buy a stock, help me think through this. So if you buy a stock and the stock goes up, like say you buy one stock for $100 and the stock goes up by $10, and you sell your stock, you make $10. If you short a stock and the stock goes from $100 to $10, then you make $10. Because if it goes down by $10, you make $10.
Correct.
But on the flip side, if you buy a stock for $100 and then it goes down by $10 and you sell it, then you you lose the $10. But on the flip side, if you short a stock and you think it's going to go down, but it keeps going up and up and up and up, there's no limit to how high that stock can go. So it can blow up your whole portfolio.
Correct. Absolutely correct. Options
So
are
if you just do normal trading, you buy a stock and it goes down, it can only go to zero. So you can only lose whatever you put in. But if you short a stock, you can have an infinite loss. I know, a ton of money, and your entire portfolio can be gone.
absolutely
So
correct. Absolutely correct. Yes. And options work the exact same way. In other words, if you buy one of these contracts where you basically or you sell a put option, you sell this contract to someone else, it can only go to zero, right?
Mhm.
But if you sell it the other way, then yes, it can go up to an infinite amount, and you can have, in theory, infinite losses. Yes.
But if it's an option though, and you don't have to sell it, can't you just walk away from whatever you put in? Like insurance? Because using your insurance analogy, you can just not cash in the insurance.
You could. So if you own it, you bought it from someone else. If you choose not to cash it in, you don't have to cash it in. You're fine. If you sold it to someone else, it's their choice whether they want to cash it in or not. And if they choose to cash it in, you're holding the other end of that agreement. You have to pay out. Just like how if you decide to make a claim against your insurance has to pay you out. Because you can be on both ends of that transaction with options.
So is it possible then that if you're trading, are these individual trades or large aggregate trades? Because say I buy an option to short something from someone else, and then somehow it goes south, and then they can't pay it out.
Mhm.
Does that mean I can't get the money, or?
So you will always get the money because that's the deal you have with your broker, right? So in other words, I can't buy an option from you. We have to go through a broker. So basically, I go through a broker, you go through a broker. And yes, I buy the option from you, but the broker promises to make me whole. So basically, whatever money I make, my broker will pay me. And then the broker will work with you to make sure you can pay, right? So yes, in other words, there is that position that you can't pay, but that's a problem for my broker, not for me. I'm going to get my money.
I see.
So that's why it's the broker's responsibility to make sure if you sell an option, you have enough assets to cover that option. Like the broker will not let you take a risk you can't pay out.
Okay, that makes sense. It's still a lot, but let's move forward then.
Sounds good. So again, 4 different types of contracts you can buy. If you think a stock will fall, you can buy a put option or you can sell a call option. And again, a put option is insurance that a stock will fall. A call option is insurance against a stock rising. So if you think a stock will fall, you can buy a put or sell a call. And if you think a stock will soar, you can buy a call or sell a put. And again, like, as we mentioned before, you don't need to own the stock. So you can just speculate on this till the cows come home. Super risky, a lot of fun. I mean, if people who are gambling junkies, it's very similar to going to Vegas and playing craps, right? I mean, you have very high highs and very high lows, and you can make a lot of money quickly, lose a lot of money quickly. There is an adrenaline entertainment type aspect to it, sadly. Now, to help this, what we've done is we took one of the stock trades that Nancy Pelosi made just to highlight a real world example of how this works. So again, Nancy's net worth is above $100 million. And so she only speculates maybe 1 or 2% of her net worth in options, right? So she has like most of her wealth in stocks, and then she speculates with a small amount of her wealth for fun in options. So let's take this one as an example. So on December 17th, 2021, she purchased Google options, and these were call options, and she spent between $500,000 to $1 million. But let's say she spent $1 million on these call options. And what she said was she made a bet that the stock was going to go up, and that between now and September, it was going to be higher than $2,000, right? So she's expecting the stock to go up. And as long as it's more than $2,000 a share, she's going to get a lot of money. Now, it should be noted, the stock was already higher than 2,000 at this particular time. And so she's expecting the stock to go way higher. And so the best way to illustrate this is to look, okay, what happens if she stakes this $1 million and she buys stocks of Google versus a call option in Google. So the easiest one to understand here is stocks, right? This is how most people invest, like you and I. You have some money, you buy stocks with it. So in this case, if she were to spend $1 million on Google stock, on December 17th, 2021, Google was trading for $2,850 a share. So if the stocks would have gone up to $3,200 a share in the next 9 months, right, she would have had a gain of 12%. Her $1 million would have went to 1.12 million. So she would have gained 12% on her investment. Very good to gain 12% in 1 year. Nothing wrong with that. And on the downside, let's say Google actually goes down to $2,400 a share, which means it goes down instead of up, and it goes against her investment thesis. She would have lost maybe 16% here, is what we calculated. Her $1 million investment would have been worth about $842 million in September, so she would have lost 16%, right? So either up 12% or down 16% on a $400 move. So we're looking at Google today being $2,850, going up 400 to 32, or going down to 24. Okay, so you can see the losses there. Now, what she said was she's very, very certain Google is going up. So she bought a whole bunch of different options for $1 million. So she just bought a whole bunch of these contracts called call options. And if, like the particular one that she purchased, if Google goes up to $3,200 a share by September, this will be worth about 1.76 million. So she would have gained 76% on this investment. But if Google goes down to $2,400 a share, she would have lost 41% of her investment. It would have gone down to about 0.6 million. Also interesting to note that the options she bought had a $2,000 price. Like, remember I said a few minutes ago that she's betting that it's going to be higher than 2,000. And this is going back to your earlier question, Chris. If something happens with the market and Google closes below 2,000 in September, she loses it all. So if Google goes down to $1,900 per share, as an example, her $1 million investment is worth zero. Like, poof, it's gone. Whereas, like you said earlier with Google, I mean, if you own stocks, it's, even if it goes down to $100 a share, you still own $100, right? Like, you don't lose everything until it actually goes to zero. With options, as soon as it goes past your limit, it's worthless. So she's really, really betting on Google going up. And yes, if Google goes up, you can see her gains are much higher on the options than with the stocks. If it goes down, her losses are much higher than with the stocks. So it
can you cash in these options at any point, or do you have to cash it in on a specific day?
You can cash them in anytime, but there's a time component, which means the more you hold it, the more money you make. But yes, she can cash this in anytime between now and the expiration in September. That's correct.
So it seems like options really just amplify your right calls, or they also amplify your wrong calls.
Correct. Absolutely correct. Yes. It's basically your stock portfolio on steroids.
Okay.
Yeah. And I think Nancy's doing it the smart way, which is most of her net worth is in stocks, and then she takes 1, 2, maybe 3% of her portfolio, and she essentially gambles, right? She says, you know what, 1 or 2% of my portfolio. It's kind of like people saying, take 1 or 2% of your portfolio and put it in Bitcoin or whatever, right? It's a highly volatile, highly risky investment. But look, if you get lucky and it turns out really well, you can make some serious gains. And if you have some serious losses, it's only 1 or 2% of your portfolio, and it shouldn't affect your overall quality of life. So yeah, that's the gist of it. One last thing I want to touch on here is the covered call. This is how most people get started in options. This is the least riskiest way to do it, which is, let's say you buy 100 shares of a stock. I used Citibank today. So I just before we started this recording, Chris, I checked Citibank. It was trading for around $48 a share. Mm-hmm. And with option contracts, every options contract is 100 shares. Right. So when you buy an option, one options contract is equal to 100 shares of stock. It's just the way they do it. It's just don't ask why. That's just how it is. And so let's say you want to buy 100 shares of Citibank. Right now, Citibank is trading for $48 a share. So that costs you $4,800. And what you do then is you say, okay, I want to sell a call, which means somebody out there thinks Citibank is going up really high, really fast, and they want to buy a call, right? They want to buy exactly the type of option that Nancy bought there. And so they're looking to buy a call. And so you say, okay, $52 a share is the option, and you sell that, which means if this thing goes well beyond $52.50 a share, you will sell your shares to them for $52.50 a share. And they're paying you $150 for this privilege today. So you buy your shares for $48 a share, you sell this call option for $150, you pocket that $150 today. Now, it might not sound like a lot of money, $150, but keep in mind, on a $4,800 investment, that's a 3%, right? That's a 3% discount. That's a 3% return you're getting right now, right away. So you buy your stocks, your 100 shares for $4,800. You keep the 150 as pure profit right now. So you get an instant 3% return. And so really you only pay $4,650. It's like that 150 discount you get. That's your money in your pocket right now. And you never lose that 150. You get to keep that forever. And if the stock goes above $52, you sell it for $52 and you make your whatever $4.50 on the shares. Fantastic. You made some money. If the stocks go down, the stocks go down. That's part of being in a stock market, but you always keep the 150. And then if the stock, let's say, goes to 51 or 51.50, like they go up, but they don't go to 52.50, you still keep the $150 because this thing is worthless until it goes to 52.50. So this is just a way for you to collect a little bit of, like, it's kind of like collecting rent on your stocks. Like you own your stocks, you can collect a little bit of rent on it. You can collect these little bit of money on it. And you can do this once every 1 or 2 months. I mean, right now, the expiration on this is mid-June. It's about 6 weeks away from today. So you can do, in theory, you can collect $150 on this every 6 weeks. And the only risk you have is if something amazing happens to Citibank and Citibank goes to $60, $70, $80 a share, like it just takes off like a rocket. You don't enjoy it. You don't get the benefit of that because you have to sell it at $52 a share. But if you tell yourself, look, Citibank is this big lumbering company, they're not going to take off, whatever, I'm pretty sure they're not going to go above 52.50, then yeah, you just take $150 every 6 weeks, and it's a great return. And then once in a while, Citibank will go to like $57 and you lose your Citibank shares. You still get paid out at $52.50. You can then take that money and buy Citibank shares again if you still think Citibank is a good investment at that time, or you can take your money and go invest it somewhere else. But this is how most people get started in options. And if you think about it, there's really no risk. You're never going to lose any more money than you would have lost on just the stocks themselves. So in other words, the shares and this call are always married, which means you either own both of them at the same time or you get rid of both of them at the same time.
Okay.
And that way, this is just a very low risk way to collect a little bit of money on stocks you already own. And then eventually you get confident and you start selling the calls without the stocks. And then when the stocks take off, you have a huge loss. And then you sit there saying, why did I do that? And then you go back to selling covered calls.
Okay.
But that's like a crash course into options. This is basically how options work. And so that's why, for example, when you read stories on the internet of people speculating in Tesla options or whatever, that's what they do, is they just buy and sell these call options or put options, hoping that the stock makes a big move. And that's how they cash in. But yeah, if you're buying options, if you're buying a put or call, you're expecting a big move in the stock. You're expecting the stock to just go crazy high up or crash crazy low. If you are selling options, you are hoping the stocks don't do a whole lot. You're hoping they just kind of go sideways a little bit until your options expire, so that the person who was expecting a big move basically loses the money on their option contract and you get to keep that money. So that's the gist of it.
Excellent. I think that was an excellent presentation. Thank you very much, Gabe. I think I'm going to have to do a little bit more reading about options, and I may come back with some more questions afterwards, but it was a good overview of exactly how options worked.
Yeah, thanks, Chris. Again, this is just meant to be a very easy, simple crash course. Options, like most other things in the financial world, they can get extremely complex, and it is a rabbit hole. You can go down this rabbit hole, and it gets very complex very quickly. But hopefully, this was a good intro.
No, thank you for taking the time. It was a very good explanation. So, what will we be, just for the listeners, what will we be talking about next on the next podcast?
Yeah, great question, Chris. Next podcast, maybe we'll get into real estate a little bit, or stocks, unless you have another option. Sorry to use that word. Unless you have another interesting topic that you want to discuss, Chris.
Maybe we can do some real estate analysis deals. There are a few deals that I'm working on right now, so we can run the real analysis of how they performed.
Excellent. Looking forward to it.
Awesome. Thank you again,
Cool.
Gabe.
Thanks. Have a good one. Bye.
Bye.